Hi, good afternoon, everybody. Thank you all for joining in on a Saturday afternoon. And so I think based on our last conversation, based on our last interaction, there was some feedback saying that, we want to talk a little bit more about, you wanted to know more about asset allocation. And I thought that, okay, since I had already done a couple of webinars on asset allocation and what you should think of when it comes to asset allocation. So I thought I'll just put out some slides of what we have done, how we think, and how you should be thinking as an investor, right? So, what is asset allocation? Now, this is a question that a lot of you would have Googled, a lot of you would have gone online, and you would have gotten very template answers as to what is asset allocation. You need to have so and so of so much, and uh, this is going to work in this particular case, this is going to work in that particular case. All narrows down to only one thing, as yes, it's all diversification. It has nothing to do with anything else. It has everything to do with your risk profile and diversification. It has nothing to do with anything else. But what it really is doing what is best for you, right? Asset allocation has nothing to do with what you're buying, right? Or it has everything to do with what is going to suit you. As an investor, what suits you? Take shopping, for example, right? Everybody has different tastes, everybody has different profiles, and something has to be tailor-made for you, and only then it would look good on you, right? You don't go buy the same template everywhere. There are different styles, there are different accessories, right? So some suit you more and some suit somebody else more. So how can you take what suits somebody else to suit for you, right? Yeah, you can copy definitely, but if it does not suit you, if it is not within your temperament, if it is not within your appetite, how is it going to suit you? So asset allocation first, right? Think in your mind that yes, this is doing what is best uh, for you, right? Always think of, no, this does not work for me. I have particular thoughts about it. I have particular goals about these things. And for this one particular thing, I need to do only this, right? So asset allocation first, simple, plain is doing what is best for you, right? Forget diversification, forget anything else, forget all the noise. First and foremost is doing what is best for you, right? So now it's a small poll. Why are you saving? Is it for retirement? Is it for wealth creation? Is it for education? Is it for traveling? What is, if there's any other reason, right, of why you're saving, uh, please put it in the chat box. Put in all your answers in the chat box. Why are you saving? Okay, a couple of retirement answers, a couple of wealth creation answers. Education, wealth creation. Okay, somebody is saving for everything except traveling. Okay. If there are any other answers also, okay, you're saving for capital protection. Very good. Wealth creation, wealth creation. Okay, so most of you have narrowed down to two things, right? One is retirement and the other one is wealth creation. Huh. So my next question to you again would be, how far is your goal? So how far do you think is your retirement, or how long of a time are you going to attach to wealth creation, or how long of a time you're going to attach to education or traveling, or for that matter, how long do you think you can protect your capital for? Okay, there are a couple of answers of about 10 years, above 10 years, above 10 years. Somebody's above 7 years, 7 to 10 years, right? These are all long term. Uh, again, there is a 7 to 10 years. Okay. Good. So I think all the answers that we're getting are all on the more than 7 year plus side, right? So now, should this matter to you? Should this actually matter to you? This is a slide that I keep putting in all the presentations that we do. Instead of it being in the beginning of the slide, I thought I'll put it in the middle of the presentation now, right? Should this even matter? So all of you have a retirement goal, all of you have a wealth creation goal, and second, all of you have a long horizon, right? So should this matter to you? Because if this matters to you, then your decisions again get narrow down to two things. One, my goal, and second, my risk appetite. Right. So you can answer to this question, no problem. Should this matter to you? And I'll keep explaining, what this entire slide is all about. Right. This entire slide is about usually when there is optimism, there are a lot of market participants that come in. Everybody wants a piece of that action, and greed comes in, and then things start to pick up. There's so much optimism that comes in. There's no scope for error, and when there's no scope for error is when there is the highest chance of error. And usually the flip happens, right? When things do not go in your favor, when things don't go in the market favor, when things start to look extremely pessimistic, people start to say that no, I do not want to commit any sort of money, any sort of capital to such scenarios, because I don't think that I'm going to be well protected enough, right? But in reality, it's flip. This is what we do at Milestones 2Wealth. In reality, it is flip. It's all about behavior. We are only seeing behavior when it comes to understanding how asset allocation plays a role for you, how your asset allocation should actually look like, right? So it's flip. You should always keep on saving, right? But when do you actually go out and start rebalancing? Is yes, you need to think first case is risk, right? So I put out a question again there saying at the end of the question, when should you rebalance? So if you look at this chart, it looks all plain vanilla. It's the same, right? You would have seen this in multiple other blogs, in multiple other videos, in multiple other threads. It's all like this, but in reality, it's long. It's not a very short cycle. It's a very, very long cycle, right? In my social way, it's flipped, right? It's more to save more when there is extreme pessimism, and to try and rebalance only when there is a case for optimism going beyond what is expected to happen or what is currently happening. Right. So these are long, long, long cycles. And you have more than 10 years plus. In 10 years plus, you don't even know how many cycles you can play. Right. And within that particular long-term cycle, there are so many other short-term cycles that keep on playing, which again hamper decision making. Right. Which again not let you see your target, and your target is your goal. Right. Because short-term cycles take place, you are blinded and you're blindsided by the fact that no, things are changing and things have happened in a particular manner, and then you'll start looking back, which is more of a rear view, which is more a hindsight, and then your biases start kicking in because of your experience, because you have experienced one particular action and that has led to another outcome, right? So these are biases that keep coming on to you for you to hamper that decision making ability. Now, I'll give you an example of how such bias, such rear view bias, comes and hampers your ability to make decisions, whereas your entire objective is to only look at a particular target, is to only look at a particular goal, right? And that majority, for a majority of you, is retirement, right? Where your retirement is 10 years plus, right? Or 7 years plus, right? That's the time horizon that you're looking to save. So 1 year or 2 years of movement should not matter to you unless and until the risks are, right? So now let's understand asset classes in general, right? When do you use cash? When do you use gold and silver? When do you use equity? When do you first let's understand asset classes, uh, cash and cash equivalents, that is your short term, is only meant for liquidity. It's only meant for safety, right? Before we get into where you should be putting your money, or what's the shots, what is the occasion in which you have to wear a particular outfit, you need to understand where you're going, right? You need to understand what it is for, right? If it is meant for you, that is more short term oriented, that is more immediate, then you need to only look at cash equivalents, that is your savings. And you need to create that mindset that yes, this is just for safety. It has nothing to do with giving me that extra return. It just has to do with safety, right? Your gold and silver allocations, definitely it's a proxy. It is a hedge against any inflation. If there is a use case for it at home where you want to use these precious metals, then definitely you cannot think of as a price appreciation point of view where you don't think of growth. Yes, this is an asset that you want to have, and it's a long-term asset that you want to have. Naturally, these are assets that are very, very limited in nature. So obviously, over a very long period of time, it would reflect. Like for example, now gold has reached an all-time high in US dollar terms. Even in India, it's reaching an all-time high, around $2,200. Right? Back in 2018, when we were investing on gold, when we were trying to save more on the gold side, it was barely somewhere around $1,200 on the gold side, 1,200 to $1,400, right? And we were able to capitalize on this particular hedge for investors who had that goal. And second, in terms of asset allocation, also you need to see how much of your current portfolio is exposed to high risk. If it's exposed to high risk, then you need to have a hedge, then you need to protect yourself, and you can use such assets to protect yourself. It's a hedge towards any sort of bad thing that happens to you. So naturally you have to commit something to these asset classes, thinking that over a long period of time, or a very, very long period of time, 10 years, 15 years, and 20 years, this would eventually give me safety and an anchor, right? It's supposed to be an anchor. Right. Then you look at PFs and fixed deposit. This usually comes in at a later stage in your life, once you have requirements for regular income to come to you, not for growth. When you have requirements for regular income to come to you, that's when you look at this sort of method of preserving your capital that gives you, you have to settle for lower returns, right? Fixed deposits do not give you more than 7.5%, 8%. So you have to sort of settle for that, which means you have to grow at high rates, high double-digit rates when you're saving for your when your retirement, and settle for lower based on inflation when you have already retired, right? So it may not beat inflation in the long term, right? Then real estate. I mean, 80% of India's wealth is in real estate. Of Indian savers is in real estate. So you can't do anything about it. It's more of a financial and emotional security, right? You need to have a house. And Indian household mentality is that घर का घर कपड़ा मकान. I mean, makan, kapda, gadi, all of that, right? You need to have a house, you need to have food, right? You need to have clothes. So Indian mentality is that yes, you need to have. So there's no debate about real estate at all, right? As an investment, it's a different debate. But right now, as a percentage of your asset allocation, there's no debate about it, right? Equity instruments, there's no other asset that is offering you high returns, that is offering you high double-digit returns, that can beat FD, that can go along with GDP growth as the country keeps growing. Naturally, equity, that is ownership. You need to look at it as ownership, right? Ownership does well, right? It's a risky investment, so you cannot have something, let's say, of a short-term goal that you use it for. You cannot use this for like I said, you cannot use this for less than 6 months. You cannot use this for 1 to 3 years. Definitely 3 to 5 years doesn't cut it out, but yes, people do think of 3 to 5 years for equity. But I would say, in my estimate, 7 to 10 years or 10 years plus is the best for any investor who is looking to save money in equity. Right. Now, understanding why asset allocation works. Now, this is what I was saying about where our biases come in and how we need to think of risk. And automatically, you will know when you have to rebalance, because you're having a long-term horizon, right? All of you have a long-term horizon. So why should you look at short-term cycles? Now, these are the returns in the last 2 years based on best performance. Now, Small cap last year was the best, 45 odd percent, mid cap 40 odd percent, international, that is your global, had done. These are more, these are all US oriented investments. If you look at world index is 60% the US only, and then out of that 25% is technology. So it's skewed completely towards technology. Then there's large caps, and then there's gold. Again, gold has done 12 odd percent, which is very good. Then there's credit, then there's GSEC, then there's a little bit of real estate and debt that comes. Then you look at 2022, gold tops, credit tops, large caps top, corporate bond stopping, but not so much. But 2022 essentially was not a great year for equity investment, right? If you look at international mid, small, not that great. So assuming you started investing in 2020, which is 2 years back, from 2022, where would you invest? Would you invest in gold? Would you invest in small caps? Would you invest in international? Or would you invest in credit? This is after you've known the result. Where would you invest it knowing that this is the result? You can put your answers in the chat box. Knowing very well what has happened, where would you invest your money? Where would you save as an asset class? Right? Because there's debt, there's global, there is precious metals. Again, there's equity. Where would you save? There's real estate also in that. And these are publicly available information. The asset quilt that LiveMint does. We've just collated it and put it in one. Many answers on small caps. There's one gold, there's one index fund. Okay. Okay, so a majority of actually have sided with international and small caps. Okay, so now I'll take you further back. Let's look at 2018 onward because you started at 2020. You are not going to see 2022, 2023, right? Because you're starting in 2020, you're going to look back. You're only going to look back at 2018 and 2019 as a filter to see when you started investing. Maybe you'll be honest. In 2020, you'll only see back to see what has done well. Back in 2018 and 2019, what did well? What did well was your debt, large cap, and gold did extremely well. Like 1 year you saw international do well, but for 2 years you only saw debt returns and large cap returns extremely high, right? But what happened after in 21, 22, and 23, your debt returns were not that great. 21, 22, your debt returns were not good, right? Which so you saw in 2018 when yields were high, right? Where yields were high, that opened up an option for investors to park money on the debt side, right? Do extremely well for the next 3 years purely on debt. And somebody starting in 2020, seeing past returns, would obviously have gone towards debt and large caps and gold. But what happens 2 years later is that small caps have outperformed large caps, mid caps have outperformed large cap, and your debt investments have not done very well. So somebody starting in 2020, creditors could not have done very well for you, right? Second, starting in 2020, seeing back, where you had two very, very bad years for small cap. Somebody starting on 1st January has put 100 rupees, has lost 23 rupees, 100 rupees has 23 rupees has gone out of that. And after that, another 9% has gone off from there. So how are you getting the confidence to go and start looking at small caps as an investment, because you're starting from 2020, so you're looking back, you're not going to look forward, right? So uh, does your answer change? Does your answer change knowing that starting in 2020, 2 years is 2018 and 2019, you have seen other data, you have seen things play out, you have experienced things at that point in time. Your experiences then and your experiences now in the last 2 years have been different. Keeping all of those things under consideration, and the most important thing is that you have a goal that you have attached to in your mind, right? I am saving for my retirement. What do you do? Does your answer change or no? Okay. Somebody has committed, will stick to C. International businesses are stable businesses, so I will rely on that. Okay, perfect. You're doing what is best for you, knowing well that your goal is far away. Okay. Okay. Somebody has said sticking to gold. Okay. Okay. Since there is extremely low return on small cap, I would stick to small cap. Okay. But you know the result, right? That small cap has done well. My point is that if you start in 2020, right, you're going to look 2017, 2018, 2019, and then take your decision on what has happened. Understanding that, yes, these are the risks that are there. You don't know what is happening, right? You're starting from 2020. So you're already knowing the result, and then trying to take a call. Right. So we are so obsessed with the result that comes in that we are anchoring everything based on that. We don't look at how things are playing out, what is currently happening. Is it making sense for things to happen the way it is happening right now? And only then try to take that call. What about other answers? Does your answer change? A lot of you have said no. Does your answer change? Okay. So now let's go further, right? Have a good look at this chart. 2018, 2019, 20, 21, 22, 23. Right. Now we'll go further. Now, assuming you started in 2020, 2018, where would you invest? Now 2020, say 2018, where would you invest? Right, you're, as per the poll, retirement was the majority option. Now you have 10 years to retire. Now you start in 2018. Now where are you going to start to invest? Is it going to be more gold, more small cap, more international, or debt? So you're having precious metals, you're having the best performers of equity as an asset class, uh, or it's debt, which is again very heated at that point. Or is it another asset class that you're looking to invest in? Because the chart had a lot of other various options as well. So assuming you start in 2018, what are you going to do in 2018 then? Okay, gold and fixed income are okay. The first option was gold and fixed income. Small cap and gold. Okay. Okay. Started a SIP in small cap in 2018. Okay. You want somebody said C international. Okay. A and B, gold and small caps. Okay, fine. So you're having more or less the same options. It's more gold, it's small cap, and there's and there's a little bit of fixed income that's coming in. Okay, so I think this this was it. So now let's look at 2014 to 2018. It's quite a long-term cycle, right? Your debt is extremely doing well, and then you have large caps that are doing well, and your mid caps that for 1 2 years have been doing well. Small caps have been extremely volatile. But for investors on the gold side, gold doesn't come out on top. Gold has had 2 bad years from 14 to 15. Uh, where your even large caps were not doing extremely well. Your small cap was extremely volatile. And you're starting from 2015, 2014. I mean, 2018, you're looking back. In 14 to 18, the liquidity also was a crunch and in small caps. And today, small and mid caps are 35% of you know, the broader indices. Back then, it was not. Back then, it was just half that number, right? So it's not very deep. It's not very liquid, and too much money going in naturally is going to pump up the rate. But for you, debt has done extremely well in that cycle. Your corporate bonds, your GSEC has done extremely well, and then large caps starting to come in the picture. Right, your small and mids have been extremely volatile. Right, so you can't take a bad year on small and mid caps. Right, but your debt has done extremely well here. It's continuously staying up, and then your international again has stayed high, right? So when somebody had said, I'm going to stick to international no matter what, I'm going to go to a stable businesses, you've been winning continuously. You've been doing extremely well, right? But there have been new winners. There are new winners from 14 to 18, and there are new winners from 18 to 21, and from 21 to 20. Today, we are having new winners. The winner has not remained the same for at least 5 years or so, which is half your period for retirement, right? The winners have kept changing, right? So when you're having this sort of a long-term horizon, I will raise this question to you: when do you rebalance? Because here every year there's a different winner. Every year something else is happening, right? And that's why I prompt to ask you this question: is your answer going to change? And a lot of you have said that your answer is not going to change, right? Which for me is a very very positive sign. So now I'm asking you again: is your answer going to change, knowing very well as to what has happened? So you start at 2018, you've seen 4 years back because you're going to judge, well, you're only going to watch from 4 years back. You're not seeing. Somebody commented in the long-term cycle, large caps not giving good return in the graph. No, actually, large caps have been extremely stable. They have been extremely stable. And the last 10 years, if you say large caps have come in the top three multiple times, right? That's one, two, three, four, five, eight, at least 50, 60% of the time, it has come up on top as the top three. So does your answer change? Large caps have been extremely stable. They are offering you that, stable growth, and it's offering you capital protection also, because you just saw 1 2 bad years in terms of negative returns. Otherwise, it's not had as big of drawdowns as small and mid caps. Hey, so my question again, is your answer going to change? You started at 18, saw 4 years back from 14. You saw that there's a different winner. Is your answer going to change then? Answer is going to change. Yes, I would include large cap, assuming that my return in the next is 5 to 7 years. It's better to focus on capital protection. Don't know what to do. I'm confused. This is why asset allocation comes into picture, right? This see after seeing how reality has played out, after seeing how things are playing out, you are bound to get confused. You are going to get confused because we are so anchored to seeing every year as to what has happened, and we're constantly looking and listening to the noise outside of what is coming, be it on social media, be it on newspaper, that we get so confused, and that leads us to not be able to take a particular decision. But I am here to tell you that no, you should be able to take that decision based only on one thing, which is your goal and which is your risk appetite. If you cannot weather volatility, if you cannot weather anything, but you have a lot of time in your hand for you to build and build into riskier assets, then you should focus on capital protection and go towards uh, uh, parts of the market that offer you capital protection at the same time offer you growth. So this entire chart is meant to confuse everybody. It's not around you or me. It's meant to confuse everybody because the market is like that, right? I will trim down my funds if my asset allocation goes beyond 5%. Okay, right. So I appreciate the honesty. Yes, yeah, it is very confusing. 100%, it's very confusing. Right, and I appreciate the previous participant also said, yes, I am going to change my my asset allocation. I am going to change as to what I'm going to do. Now you look at the whole chart. This is from 2010. 14 years is a big cycle, right? 10 years plus 14 years is a very big cycle. 2010, 2011, gold did extremely well. 13, 14, 15, gold very, very poor. Large caps did extremely well till 13. And then for 2, 3 years, they've been extremely poor, right? Your small caps and mid caps have wavered so much where for 1, 2 years, look at the 2011, they are the worst 36, but 36, 35% out. The large caps 25% out, right? There are only one or two asset classes that did extremely well in that very bad year for us, right? And then this is assuming somebody starts on day one of 1st January in that particular year where you make 40%. How would you make 35%? Other than that, that's an assumption. That's not reality at all. That's literally assumption. But we have not lived. We might start sometime else. We might start in another place. But the data that is coming to us is this, right? So we are going to make that decision only based on this particular data, and that's why I gave you this particular data, right? So for so from 15 all the way till 18, debt has done extremely well, right? From 18 all the way up until now, again, where we had bad years on gold and no return on the gold side, gold has done extremely well, right? International has stayed consistent throughout, barring one bad year, right? Real estate has done well only for 2 or 3 years, but it has had consistent appreciation, very slow appreciation, but it has had. Right. This is based on the index. This has nothing to do with real estate actual prices, right? Then your small and mid caps have been extremely volatile, right? You look at couple of years, small cap mid caps have been on top. You look at the other years, small and mid caps have not been on top. 18 and 19, again, you had bad years on small and mid caps, right? But it has been extremely, extremely volatile. So as a saver, will you choose to park your money in something that is extremely volatile when you know that optimism is high? If you see in the long term cycle, when you know that optimism has been growing extremely high, where there is no sort of fear in the scope of error is very low, would you want to park your money there, knowing well that this is going to be your retirement corpus after 10 years, and you have to settle for something that is going to give you somewhere around 8 or 9% return from a fixed income perspective that is more regular and stable for you, right? Because when volatility turns, it pulls you back, which means your time horizon for retirement. Let's say you've decided that after 12 years I'm going to retire, and volatility comes in, it pushes you further, say 3 or 4 years down, saying yes, that I have to extend my time horizon to retire. Right. So would you want to put yourself in that sort of a situation? Right. So knowing very well that this is how long-term cycles actually go out and start playing out. Right. This is how investors keep getting trapped. You're going behind the best performing asset class in each year. And because of that is all public data. Now, because of that, you're losing out on whatever returns that you're supposed to be making out of that particular asset class, right? Forget choosing the best one. That asset class is supposed to give you somewhere around 9 to 12%, right? But because you're chasing performance, you cannot compound, nor are you being able to stay at the right place at the right time. Right. So most investors rely only on past performance to make investment decisions. This is be it on debt, be it on equity, be it on precious metals, be it in any particular asset class, the understanding of that particular asset class needs to be extremely strong for you to know that yes, if I'm committing this much money of my savings to this particular asset class, my expectations should be set right. Right? Your debt, your cash equivalents cannot be touched, cannot be extremely risky. You need to settle for 3%, 2.5%, 3% sort of savings account rate or anything of that sort. You cannot take that much risk, right? Regular income, you cannot take that much risk, right? Something that you're saving to build completely okay, which again goes into real estate or comes from real estate here, that's completely fine, right? That's where a majority of us trying to make that decision of performance chasing comes in, right? So if you see if performance chasing actually over a very long period of time cuts off 2% just in terms of CAGR for you, right? So studies have shown that an investor's effort to outguess the market by jumping between asset class and result is going to result in underperformance for you. Right. I did not put this question of how many times you're going to go from one asset class to other, but definitely I'm opening up that right now as to how many times would you go from one asset class to the other, knowing gold has done well, equity has done well. In periods, fixed income has also done well. How many times would you do this? Right. This raises that question. When do you rebalance? You only have to rebalance one when you're closer to your goal, or second, when risk is extremely high in the market. Right? You need to see that if your savings are going into asset classes that are becoming more volatile, that are the inherent risks are extremely high, there's a dichotomy in what's happening, then that's the time because you're having a long-term horizon. If you go to asset classes from there that are offering you safety, that is debt or precious metals, then naturally uh, you are on that wealth creation journey. You have a long-term journey. You cannot think that I'm going to miss out. This fear of missing out for you is going to act as a very, very bad bias when you're trying to save money. Right. These are the only two instances when you should look to rebalance. One, if you're closer to your goal and your goal is met. Right. If your goal is met, then naturally you have to go back to the drawing board to see, okay, I have met my goal of building a retirement corpus. From now, my behavior needs to change and my mentality needs to change. Second, I am building something for my retirement and I cannot take risk with my retirement corpus. So I have to go towards asset classes that offer me capital protection, safety, and only then try to go into riskier assets when the time is right. Right. So this is what we do at Milestones to Wealth. When we understand what your goals are, we are able to rebalance for you based on your risk appetite, based on whatever time horizon you are having, and give you a good experience in terms of how much you should be able to save, and from there on how long can you survive for. Say for example, if a corpus for you is to build a crore, your journey to crore starts from now. It takes you 15 years or 20 years. Your retirement is 20 years from now. It takes you so we take 15 or 17 years for you to retire with a rate of assumptions which is very, very conservative, right? So how long does it take us to reach that 1 crore, and from second, how long after that can you survive on that 1 crore? Right? So two things happen to you, right? One, how long does it take to build? Second, how long can you survive? Which is very, very important for you. You need to know how long you can survive with no income. Right. So this is what Milestones2Wealth is able to do for you. You're able to build conservatively for you in that stipulated time period for what you have a horizon for, and then ensure that these particular assets are able to generate uh, whatever expenses that you have, it should cover up for that, right? So the cover up is also something that based on conversation with you is something that we are able to plan for, right? These are the two instances where you should rebalance. One, risk management only when you know that yes, things are going extremely haywire, and now I should take that call of uh, going towards safety. And second, my goal is met. Now I need to go back to the drawing board to see uh, what I need to do next now for myself. Right. Now I'll open the floor for Q&A, and whatever questions you have regarding this topic, I'm very happy to take it up. I put the number here. So whatever questions you have apart from this, If you have any requirement, if you do want to get your asset allocation checked to see if you're on the right path, and you want to start working in terms of retirement, working in terms of building your savings in these particular asset classes, do get in touch with us. Just send us a hi, and somebody from our team will get in touch with you. Okay, so I will go back from the top to look at the questions. There was a question on. So there was a question on silver. Silver. Where do you see silver in the next 5 years? So we did a presentation and a webinar on gold, silver, and gold mining, and uh, silver works completely different than gold. Silver is not mined in a particular mine; it comes along with gold. It's when the metrics come, it's called as gold equivalent ounces, right? And the supply for it again depends on that particular mine. Uh, uh, but demand for silver is extremely high. But right now, what silver is being used is more recycled than it is more in terms of uh, the metal being currently mined, right? It's more recycled. Right. So because there is high demand going up now, and the supply is again dependent on that particular precious metal that it comes along with, there is a mismatch, and the optimism comes from this particular mismatch. Right? Though it's extremely volatile, you can go into Milestones to Wealth on the YouTube page, and you can just search for. You can just scroll down to the live section for webinars, and you will get gold and gold mining, gold and silver and precious metals. There is a good chart on how volatile silver is and some information on silver, right? And how mining works for gold and silver. So that will give a very good insight. But in the next 5 years, precious metals is definitely poised to do very well. Next 5 years and after also, naturally the supply is very low, and it's very expensive to mine. Cost of mining has definitely gone up because of inflation. So that should reflect in the current prices for metal, but it doesn't mean that it should happen right away. How to predict and play the safest bet for the next 10 years as per past record. You should not look at past record. If you want to know how to be safe, don't look at past. You only learn from the past to see what has happened. Don't go by, okay, this has happened in this particular, which means this is happening in this. If you look at your own past, right, you would have been a different person back then, and you're a different person now. So the decisions that you take back then doesn't define you today, right? You've learned from it, but if people were to anchor you on that particular decision that you made, nor are they going to grow, nor are you going to grow, right? So you look at past record to see what has happened based on that particular scenario, why things have happened in that particular manner, and then try to take a decision as to, okay, how have things changed right now, and what is currently happening, right? You always need to be safe. You always need to look at, when you're looking at equity investments, when you're looking at debt, you always need to be safe. You always have to think from a conservative standpoint. You cannot think that, yes, just because small and mid caps have given me high returns, they'll continue to give me high returns. Uh, Things are heated. So if you're able to get over the fear of missing out, and say, no, I will go to other asset classes that are giving me that safety, unless I feel comfortable to go into the market, into these particular this part of that particular asset, then you're fine. When should one start reducing equity exposure? When risk is high, when valuations speak out, when fundamentals, when earnings growth, or rather when valuation growth is much higher than uh, earnings growth. Maybe I can give you one example. There's a very good chart that showed, which part of the market has good earnings growth and which part of the market has had valuation growth, valuation pre-rating growth. And then you would get a better understanding of how to gauge these things, right? Second, get a professional advisor for you to do that, because things are getting complicated. DIF flows are extremely high. We are continuously pumping in money. So the scenario what you saw before is not the scenario right now. Yes, so we are continuously pumping in money. So you need some hand holding in terms of what you should do and when you should do. What will happen to equity and bond market if there is a nuclear war? What Will it still be a temporary fall, or will it result in something like a Great Depression? Any chances of repetition of 1929? I don't know. Honestly, I do not know. This is high level of speculation that even you don't need to think of, right? Nuclear war, any sort of war, nobody predicted the previous wars also. That time the scenario was different. That time consumption and sin did extremely well because you have to keep the soldiers happy. Uh, Anything to do with sin did well. Anything to do with consumption did well. That was the actually that was the base for innovation in terms of consumption and consumer growth. That led to innovation, that led to various other person, that led to modernization of plants, that led to volume growth, that led to a lot of things. So there are parts that the war brings out the best, but also destroys. So you don't think of a war, and nobody can afford a war right now, but you cannot predict a war also. So don't think that's this is very high level of speculation, which you shouldn't think of. Like you don't know what's going to happen. Yes, since India market is overvalued, is it better to focus on conservative investments like fixed income or gold? Yes, parts of equity markets are expensive, not all. If you want, to start off with equity investments that are more on the conservative space, just send us a hi and we will be able to do that. The model for Milestones to Wealth is more behavior oriented. It has nothing to do with uh, this fund and that fund. It has everything to do with behavior. In today's market, it says that yes, even on equity investments, you need to be a lot more conservative. So we would only start building into conservative parts of the market rather than going or chasing performance. Great. I thank you for your support. I think then you know that if you look at your portfolio, then you would know what we are trying to do and how we are trying to handle you in this entire process of saving money and also making sure that we are trying to manage asset allocation. Thank you, sir, to keep sending us feedback on the webinars that we're doing, on the content that we're doing. Do give us newer topics also for us to work on, and we'll definitely be able to do a lot more work and keep following us. You will get a lot more content in terms of what we're doing, and things for Milestones to Wealth are only going to start getting bigger. So I don't think there are any further questions. If there are further questions, I'll keep the floor open for another minute or so. If not, then definitely we can close. Okay, so I don't think there are any further questions. So thank you all for joining in on a Saturday afternoon. Do send us a hi. Do send us a message on this. Somebody from our team will definitely get in touch with you, and we will be able to handhold you in the process of you saving money, in rebalancing our assets, and maintaining a good asset allocation split for you based on your risk profile, based on the goals that you are having. Thank you so much. Have a great Saturday. Have a great weekend ahead. Thank you all for joining me.